You are listening to another episode of the What's Next podcast, and today we're going to be talking about Phil's favourite city, Wellington, because we're talking about the working capital. See what I did there?
Wow. Jeez, when we don't have intro music, did you just think about that?
Yeah,
as
30
we
seconds
hit
ago, and I
record?
thought, oh, this is gold.
Man, you love a 30 seconds?
Yeah.
Man, that's sensational.
Yeah, would that be your favourite city?
Fuck no.
Yeah, not a big fan.
Nah. I mean, I've only ever been there for work.
Yeah.
I mean, we're doing serious pods and we're already on 10 genes.
Yeah.
And an interesting city. I will never forget that morning that we were down there before a particular client meeting, and we were having a coffee and we were just casually watching the world go by on, I want to say Cuba.
Yeah, I think you're
Street.
right. Yeah.
It's a popular street in Wellington. Apparently, there's the only other name of a street I know is Courtenay Place.
Yeah.
Is that it?
Yeah.
And that's where all the bars are, apparently?
Yeah, Courtenay Place. Yeah.
Or something, Courtenay Place, Courtenay,
Yeah,
I don't know.
hey, who knows? Pronunciation.
Yeah,
Sweet.
but Cuba. And we sat there and I was amazed.
There were some creatures. Remember the guy in the full camo outfit? That was my favourite. 8 in the morning?
Yes.
Yeah, I think
I don't know who he was trying to hide from.
No.
But look, I did feel somewhat out of place because I wasn't wearing Doc Martens.
Yes, they were very prominent down there, weren't they?
Extremely.
Shout out to all our friends and foes in Wellington. We hope you're looking after yourselves. Let's get into it. Working capital, the working capital. See what I've done there. What is working capital, mate? Give it to the people straight.
I still can't get over just the degree of just entertainment and play on words on working capital. I mean, my mind is just...
Yeah, I've got a bit on.
Whew, I've got to refocus. What is working capital? Well, broadly, working capital is your current assets less your current liabilities.
Shit.
Yeah, we're just going straight in full nerd mode
That's
here.
a real accounting exam sort of answer, isn't
yeah,
it?
so for all you people listening to this, you probably switched off and gone, wow, you lost me there, Phil. Yeah, it's probably because it's on a report called a balance sheet that as you business owners, you don't look at. Why don't you look at it? Because you don't understand it. I get it.
Yeah, fair enough. You didn't do an accounting degree.
Yeah.
You weren't that stupid.
But when we talk about current assets and current liabilities, current normally refers to stuff that's going to happen pretty soon. Typically in nerd terms, 12 months or less. Is that the audit definition still?
I'd say so. I haven't reviewed it recently, but I'd say so.
But look, enough of the techo boring batshit stuff. The more important thing about working capital is it relates to the all-important thing that business owners love is cash.
See Ash.
Phil, Luke, show me the money.
Yeah.
Well, we can. And working capital is where your cash is tied up in the short term. So in order to make money in a business, you've got to spend money. And you're going to have to go out and buy a widget. And then that widget is going to sit on a shelf, or you're going to add another widget to that widget and have a super widget. And it's going to sit on a shelf or in a warehouse or somewhere. And then Barry the Baptiste is going to come along and he's going to place an order, and you're going to go, brilliant, we're moving these widgets.
Bless up, Barry.
Yeah, and I'll take two. And you ship those out to old Bazza. They've been sitting on the shelf for a couple of weeks. And bear in mind, you've paid for those with cash. So think of stock as cash sitting on a shelf. That's kind of gross to think that you've spent money to then put it on the shelf.
It's tied up.
Yeah. So then Bazza comes along, buys those, and he goes, hey, look, fellas, I'm not going to put this on credit card because you don't have a Shopify platform for me to be able to pay by credit card, and you haven't set up your Stripe platform on your Xero invoicing. So just put this on my account. I'll pay it 20th of the month following. And you're like, sure, that's the way we do business in New Zealand.
Certainly.
So you send out that invoice with the widgets to Bazza, and I hope people are following me along with this journey because it's quite a long one.
Yeah.
And we get to the 20th of the month following, and Bazza's had the benefit of his super widgets. And happy days, and you send him an invoice reminder out of Xero because you've turned those on. But Bazza, being the bright man that he is, hasn't turned his computer on and has missed the email following that up.
Oh dear.
So it's the 20th, and it goes to 21st, and it's the 22nd. And because in New Zealand we're scared of picking up the phone and saying, hey, Barry, where's my money? You owe me. You wait. And then we wait again. And then finally you pick up the courage, and it's the 10th day of the new month, and you go, yo, bro, where's my cash? You had to pay me like 20 days ago. It's overdue. Oh, yeah, no, sorry, I forgot about that. Can you resend me the invoice?
Oh, that old chestnut.
Yeah.
Oh, I never got the first one.
Well, we can't say the check's in the mail anymore because people are like, what's a check? Unless you live in Gore. I think they still use them down there. I don't know. Correct me if I'm wrong if you're from that neck of the woods. Just like throwing that part of the town under the bus. So you promptly send the invoice to Barry, and he gets the invoice, and he looks and it goes, oh, yep, cool. Oh, I'll pay that on the 20th of this month because that's when my customers are going to pay me. And you're just like, oh, Barry. So Barry's account is now 1 month overdue. You've been without the cash from the time that you've bought the widget at day one. It's sat on your shelf for a couple of weeks. You've then sold it to Bazza, who's then strung you out like you wouldn't believe. You've been without that cash for, 90 days?
Let's say 6 weeks, yeah. Let's just say.
So let's say that's $100 that's gone out of your account. The account's in overdraft. We're paying an interest rate on that, and interest rates at the moment on an overdraft.
86%.
Feels like it. Heartland Bank will probably do you a deal, surely.
About 12% at the moment, looked yesterday.
Yeah,
Yeah.
good man.
12 to 19.
Any
depending
update on that share price?
Yeah, listen, come back to me in 3 years.
So you've been without that $100 incurring an interest cost on it because you're in overdraft, because we started with zero, we're negative 100. We've sold it to Bazza for 200. So we're like, where's our $200? And we've got to wait, and we've got to wait, and we've got to wait. And then it finally comes back to us 90 days later, we get our $200. So our bank balance goes from minus 100, minus the interest for 2 months. So we're probably minus $120 to then be positive, whatever the maths is, $80.
Wow. So what did we learn there?
That is the working capital cycle
The cycle.
of cash going through your business. Now, the secret for business owners is how do we shorten that cycle? And there is a stack load of tips in that story. And tip number one would be get better customers.
Nice. Fuck you, Barry. Sorry. No more. You're paying when you come in the door.
Or you say to Bazza, look, bro, we'll sell you these and we know we've got a quality product, but we need your credit card details. You got to pay now. And he might, And you go, well, okay, if you're going to say, no, I know I'm going to sell this to somebody else because we've got a great product, your no is going to lead me to my next yes. Have confidence. Or you might not back yourself to be asked for payment up front and have the ability to, well, you certainly got the ability to do that. You're probably just chicken to use it. Ask for a deposit and say to Barry, hey, look, for you to take these goods now, you're going to have to pay us 50% up front. I think with the advent of e-commerce and platforms like Shopify, there is no excuse whatsoever for you not to get paid straight away.
Yeah.
And we've got the cash. And people might go, but the credit card margin, I don't know what it is on these platforms these days that they take a clip of the ticket. But you've got to ask yourself, the cost of the credit card fee, is that cheaper than not having the ability to use the cash and reduce the interest rate cost? And I think if you're doing it at scale, the answer is probably yes.
Accept the fee.
Accept the fee.
Or even bolt it on if you can. Get away with it. Yeah.
Bolt it on.
And if you can't, and if you are one of those business owners, it's like, that's not how it works. We just send our invoices and people pay us when they feel like it. Well, then you, again, going back to, pod of you being the problem in your business, then you're not going to solve that because you're not trying to, you're not willing to because you think that it can't. Okay, then you can't complain about that. So you have to understand your cash flow cycle because you're going to do the work, pay the wages, pay the insurance, pay the rent, pay the staff amenities, all that stuff, pay for the product, do it. And then you're going to ship it to the customer and you're going to say, pay us 20th of the month following. You've got to be able to run the business and have enough cash to be able to pay for everything until they pay you.
Yeah, and there's no guarantees on when they're going to pay unless you control that process. And we want to control that process to make sure we've got certainty around
cash.
when that cash is going to come in. And you're probably listening to this and going, Phil, but that's a goods-based business. What if I'm in a service-based business? The same principles apply, but instead of paying for something physical, we've paid wages. And those wages are going to be used to produce some kind of output. And it might be whether you're a lawyer, an accountant, or an engineer or something, and it's their ability to convert that time into revenue. And it's a throughput game. Have we finished a project, and are we in a position to be able to send a bill? We send the bill. Does the client pay? Then it becomes the same issue as Barry. The issue there is if we don't have, if the stock is sitting on the shelf for too long in a service-based business, and that's the time, the employee's the problem. Fire them.
An employer's market, it's easy to make that the answer. Yeah, I like it. Good heat. I think the lawyers, mate, a really good example, might help people understand this, because if you think about it, business owners out there, sometimes a legal matter can go over 12 months.
Yeah.
And some firms historically in law and even accounting, they will basically go, righto, well, we will just keep running up cost on solving this problem for you. And then they send you the bill once the job's finished. So think about it like that. So basically every month they're working on the case, so it's still not finished yet. Okay, we're adding up more time. So what they have in the background is something called WIP, which is just another acronym to piss you off so that you don't understand and learn about accounting and finance. But it means work in progress, which very simply means the work is still in fucking progress. It's actually not that hard, but we like to use terminologies, don't we? You know, so the work is in progress. Oh my gosh! But instead, people roll, "Hey, what's your whip balance?" What do you mean by whip balance? Man, I'm not whipping anyone. I'm not a jockey. Anyway, so they'll have work in progress where basically every month they're adding to this and they're thinking, man, we really need to get this work out the door, but it drags on and on and on. And then so let's just follow that through. So eventually the job finishes and they go, righto, here's your bill. And it's a law firm, obviously. So there's $128,000 plus disbursements of $13,000 and the photocopying and the photocopying. And you came in and had a whiskey on one of the Fridays too. So we'll bolt on $200.
For disbursements of that much, they've got to be a top tier law firm.
For sure, because you're paying for that office. Trust me. Anyway, then they send that to you and then you go, okay, we have to pay that. And now they're actually just recovering all of the cash that they've spent on staff and the disbursements, the office, all of these different things, right? And then they've got their margin, then they can take their cash. But until they bill you and you pay them, they can't actually access that. So what some legal firms figured out quite quickly was, well, that's ridiculous. We're going to send bills as we go, and you're going to pay monthly or 2 monthly or a progress payment, much like we see in the construction industry, for example. So, and that's where then they get into arguments. Like, oh, well, you know, they feel like they haven't had their outcome yet. This thing's dragging on. And so what, you're sending me a $60,000 bill, like, and they can't see when the end of this is. And so I think that's where arguments happen in accounting and legal firms, where people feel like they haven't had the outcome, so don't want to pay that bill too. But same thing, they still have to try and collect it.
I think in a service-based industry, it's the art of making sure that you're delivering value and the client is aware of that value along the way, so that when they do get the progress bill, they go, oh yeah, that's right, I've received this, or I've talked about that with whomever it is, and oh yes, it is moving, I can see some value, I can see progress, therefore, boom, I'm prepared to pay that.
Yeah.
Rather than going, oh shit, they're doing stuff in the background and boom, you get hit with that big bill plus disbursements, and you're just like, shit, I haven't heard from them.
Yeah.
Yeah, what are they doing?
Let's look at a different example, mate, where basically they're collecting their money ahead of the event happening. Now, we actually saw this through COVID a little bit, where they were ticketing events and then the events got cancelled. But they were using the money for the event as working capital. So they would collect the cash from the customer saying, yeah, yep, you've got your ticket, you've got your allocated spot at the concert that's coming up. But then they needed to fund the business. So that cash became their working capital and the capital that they would use. They spent it and then everyone's like, well, hey, I want a refund because I can't go to that anymore. And they're like,
Uh-oh, spent that.
Yeah.
Drawings, Ford Ranger.
Yes, or something, right? Yeah. So that's where you can look at different businesses and figure out, oh, I wonder what's happening and how the money's moving through it.
Great that you mentioned that, because I did have that written down as one of the tactics that a business can use in the right way to really flip the working capital cycle on its head is pre-sales. And we have had a client do that in the past where it's And I won't say who they are, but it's been prominent that they've done an online new product. It's an absolute mystery of what it is. If you want to be one of the first to buy it, jump on board. And they had a huge amount of sales for a product that was not even launched. No one even knew about it. It was just pre-sold.
Nice.
And they knew with certainty that this product was coming in, and they've got sales for something that they haven't even delivered yet. I mean, that's sensational marketing to get the cash in before you've even actually sent something out.
Yeah. That is, and I think you do have to be careful. I think there's something under the Commerce Commission or something like that where you can't.
Somebody with a blimmin' clipboard.
Yeah, you have to be careful because I don't think you can sell something you haven't created. And I'm pretty sure in this example you're talking about, they had it.
Yes.
They just hadn't, like basically they weren't
Released
advertising.
it.
Yeah, they were holding it back, and then basically drew in all that demand.
It was in the stock on hand account on the balance sheet.
Nice. I had a conversation yesterday, mate, with a client who was after some help, and I think this illustrates the working capital cycle too. So basically, they've been trading for a number of years, quite profitable, and now they're at a point they're like, we got no money, and so that's why they get in touch. Can you help? So we dive in. Okay, let's have a look and diagnose everything and figure out what's going on. We're looking at the profit and loss. Oh shit, revenues come back. Okay, we've had tax bills, like money's going out. We can see where the money's going, jump into the balance sheet. Oh, okay, you've only got, let's say, 80 grand worth of debt left, but you've got 500 grand worth of assets. And this business actually owes you 180K.
Wow.
So basically what was happening is the business was profitable. They were paying their tax on that. They're up to date with everything, not overdue on anything. And then they're just hell bent on clearing down debt. Now, that's all good and well, and you can do that. But what's happened for them is that the market has turned and their revenue's decreased and they can't collect that cash as fast. So all of their cash from the last few years is now tied up in assets. So to access some cash, we have to go back to a lender and say, hey, will you lend us any money against some of these assets and take security of those? Here's the serial numbers. Can we unlock some cash and basically borrow it again? So,
and do we know a lender that can help you? Hashtag not sponsored.
No.
Heartland Bank.
Get in touch. 0800 Heartland.
Disclosure interest. Luke is a shareholder.
So it's a good example of a business thinking they're doing the right thing, but then things change. But they haven't necessarily done the wrong thing. It's just that the lever that they have is the assets, but now they have to figure out how do they turn them back into cash. The cool thing about this business is that they had actually been very diligent. Instead of pulling money out of the business and actually just keeping more debt, instead of paying themselves, they're like, no, we're going to pay off that loan. No, we're going to pay off that one as well. So they actually have an ability in the future to draw money out of this business too, where they've actually paid the tax on that. But they had preferred to clear the debt so that they own more of their assets. But now that things have slowed down, they have to find a solution to turn that into a lever to pull cash out of it. Yeah,
and I sit here and kind of squirm a little bit when people are using working capital cash, taking it out of the current cycle and just putting it immediately into something that would be classified as non-current. It can be a recipe for disaster when things economically can change quite quickly, because more often than not, as we see, a lot of businesses kind of think, yep, we just roll on, and they haven't put the cash in the shit hits the fan account for the rainy day, for these exact situations that when things do slow down, that you've got your balance sheet in such a way that you can ride through it, and they're having to go back. This broadly brings it back to cash outflows, and then thinking about accounts payable. There have been a few examples, and there was one a little while ago that you spoke about, but it was on the flip side, the customer asking, but as an accounts payable, can't remember what way around it was, but basically just asking, I want to buy this. I don't want to pay for this up front. Can I pay this off over 3 months?
Yeah.
And I think a lot of people, again, it just comes back to ask. A lot of people in business want to be able to sell, but at the same time, they want certainty of cash flow. And in order to get a sale, if it means that you're going to get paid over 2 or 3 months, that's actually better than going, yeah, you know what? No, I'm not going to have a sale this time. I'd rather get paid up full.
Up front.
Up front.
Yeah.
So don't be afraid to ask. We've got a number of clients that have negotiated favourable payment terms with suppliers. It doesn't all have to be 20th of the month following. It could be 60 or even 90 days. Or if you're a Fonterra,
89
days. But yeah, I think it comes back to that, be open and honest. And in business, it pays to be upfront about where you're at. The person on the other side doesn't want to be kept in the dark. Share with them where you're at and you go, yeah, we're all in business together. We all want to succeed. Cash is what makes this all go around. So if we can make it work for everyone, happy days.
Yeah.
But make darn sure that if you agree you're going to pay it off over 3 months, that you do it. Because if you do your first month and you don't do your second month, then not cool.
I was speaking to another business owner, mate, $50,000 of tax to pay in the 2025 financial year. So split into provisional tax, let's just say it's around $17,000 at each of those installments, right? Now, I jumped into their zero and I'm like, oh, well, what you're telling me, your profit and loss matches this up. You're not actually profitable. I said, your obligation in August is to pay $17,000 of tax out of working capital. You don't have it. So I'll tell you right now, you're not paying it. So when they ask you for it, don't worry, you're not going to pay it. And so then we had to go down the journey of, okay, well, how does that work? Because no one had educated them on that. So I said, well, what's going to happen is you're going to miss that. When we get to January, we're going to have another look and say, like, okay, what's it looking like now? And based on what you're telling me, it's not going to be any better. So I doubt that you're going to have a profitable year in 2025 like you did in 2024. So later in the financial year, we're going to have more understanding of that though. And you might pay the correct amount in January. If by some miracle you actually are just as profitable, then we're going to use tax pooling to buy back the missed payment in August. But right now, your working capital does not allow for that. So you will not be making that payment.
Ooh. I think with working capital, which involves cash, making decisions on what to do with cash is going to be easier if you've got a plan.
Yeah.
And it still breaks my heart how many business owners just don't put some level of thinking into that. And then even just doing some rough calculations, looking, and I've spouted on about it, I don't know how many times now, but it doesn't need to be overcomplicated. It can be easy. Even just 3 or 4 months into the future of going, where's the cash coming from? Where's it going to? What's it going to look like? Because as we spoke about at the beginning, with the example of Barry buying the widget, we're without cash in our business for, in that case, potentially 90 days. So there's 3 months that we don't have cash coming in from something that we sold or originally purchased on day 1 that we then get the cash for on day 90. How can we have visibility of that and going, right, well, that's month 3, what's going to happen in the rest of month 1 and 2?
Yeah.
And going, oh, yeah, no, gee, actually, I've still got wages to pay. I've got rent to pay. I've got the accountant to pay. They've got to be paid. There's insurance. Hopefully I sell some more stuff in month 2 as well, but that's then not going to get paid until month 3.
Yeah.
Because they'll hopefully pay on time. Baz is just useless in paying late. But there's all these balls in the air that you're having to juggle, having it down on paper going, right, the ins and the outs, what's my bank balance, where's it trending, are there any holes? If there is a hole, how am I going to fix that hole? And that's where having a conversation with somebody like Luke, who'll be able to go, hey, this tax payment that's due, you don't have the cash in the bank, so let's use tax traders. We kick the can down the road. But it's just having that visibility of what that future state is going to look like so you can make the decisions today.
The 90-day cash flow plan in a time like this is such an underrated tool of just looking at your next 90 days. We find, would you say it's probably higher than 80% of business owners, when you start trying to do forecasting beyond the 90 days, you literally are just kind of going, oh, we think. That's when people start saying, oh, we hope, oh, we think.
Yeah, crystal ball gazing.
Yeah, but in the first 90 days or the next 90 days, say it's, August, September, October, for instance, I feel like most business owners are like, oh, I know what's coming in 2 of those months, and I think fairly confidently that in the 3rd month we'll be getting this. And they can see the next 90 days, they can see the next quarter, but they often can't see beyond that, and it becomes a guess. And that's where it gets into like, well, let's just fucking ramp it up by 10% in each of those months. And we're like, no, we are not doing that. But we ask questions like, are you buying assets? Are you having to continue to clear debt? And they're like, oh yeah, actually we need to buy this thing. And you're like, okay, well, we then need to model that payment into a further month in the future. And so many business owners, I think right now, are just on the fly with cash and not actually understanding what their next 90 days looks like. And I think that if that's one takeaway someone gets from this podcast, is just, what money do I have coming in? What money do I have going out? So all your expenses, your loan payments as well, your own drawings, every piece of cash that goes out has to be included. And then what's coming in, cash collected, not what you hope you're going to collect. And when you're going to collect it. So, you know, our widgets at the start, he's not collecting that cash straight away because he's sending an invoice. So he's not collecting it till the month after. You do that, you're actually going to have some visibility of, am I going to run out of money? And knowing that is enough to have more knowledge than you previously did and to keep moving.
Kick you into gear to do something.
Yeah.
I think business owners that look at cash flow kind of go, oh, immediately, that's really hard. I don't know where to start. But then the next layer is, what if I get it wrong? And I think the key with forecasting of any type, whether it's a P&L budget or a full cash flow forecast that you're doing, it's not going to be right.
No.
Like, just accept the fact you are going to get it wrong.
Look at every NZX company, the budget for the government every year. It's not accurate. It's missed.
100%. Like, you look at Te Wāti Whare in recent weeks come out. We've missed our earnings guidance. It's now come down. So their CFO, their finance team have got their forecasts wrong. They told the market we were going to make this kind of much in profit, and the market looks at that and go, oh, yeah, kind of profitable. We'll tip some money into that and buy some shares because we might get a dividend based on that level of income. Then old Adrian comes along and goes, I'll fix that for you fellas.
Yeah.
And people go, we ain't going to spend at the warehouse anymore. And then all of a sudden the finance team there are going, oh, geez, we need to redo our forecasts. They're busy on their abacuses and their, oh, that's red. And not just the red shed, the share price. They're then going, oh, gee, we're going to have to pull some all-nighters to reforecast our numbers. And it's like, oh, gee, actually, our profit's been trimmed by over $100 million.
Yeah.
How's the market going to react to that? Not positively.
Well, I can tell you, mate, that over the last year, the warehouse group is down 47.62%. So $1 a share now for the warehouse.
Jeez. So it's in the bargain box.
Yeah.
A red light special.
Yeah, that is gnarly to look at.
But I guess that illustrates that even the big corporates get their forecasting. So when they issue like earnings guidance, that's code for like our forecasting. We've got it wrong. That's them going to the market to say, you know what, our internal accountants suck.
or they don't know.
Yeah,
you know?
they don't know. I mean, that's being unfair on their accounting team. I'm being a little bit cheeky, but it just highlights the fact that it is a guessing game. So if they get it wrong, then as business owners, if you're doing it, you are going to get it wrong, except the fact that it isn't going to be right. So just start, and if you're not sure what to put in, look at last year and go, well, okay, we're now in July, the school holidays are coming up. What happens in your business during the school holidays? It's going to do one of three things. It's either going to go better than a non-school holiday period because people go out and spend money. It might be event related. Rainbow's End, for example, we're going and rolling the roller coaster 27 times. Or it might be, I don't know, some kind of business that goes quiet in school holidays. The stationery shop, for example. I've already got my stationery, got that beginning of the year fill, so we don't need to be going buying any. We dial it back.
Yeah.
Movie theaters, for example, they might go, shit, it's the holidays, so our revenue is going to come up. You just got to take a punt and then go, well, what else are we doing to encourage people to spend money? Oh, gee, we're doing this 2-for-1 deal. That's going to have an impact on revenue. We'll probably hope to try and get 3% more than we did last year, 15% more than last year. Just start. You're going to be wrong, but then once you get it wrong, look at how badly you were wrong and then go, right, how can I stop being so wrong in the future? And go again. Yeah,
and that's why we're such a big fan of just doing the next quarter at least, because you're probably going to know that, and then you can just keep changing it each month and then set a calendar reminder and then go back, okay, July changes to August, and you can keep looking at it. I did this with a business owner recently, mate, and we identified very quickly that they could, based on last year's profitability not being higher than this year's, let's go to ACC and say, hey, I don't want to pay that provisional levy as high because I don't think I'm going to be as profitable. See what they say. Then they had a big expense for a license coming up and they pay it all in one go. I said, we're going to ring them, mate, and you're going to say, hey, I can't afford to pay the whole thing in one go. Appreciate that's what you guys like, but can I pay it in installments? Worst thing is they're going to say no. Yeah, well, okay, is what it is. Tried. Yeah, but I'm like, high chance they're going to go, oh yeah, fair enough, she's tough out there. Take it in 4 installments, for instance. I'm like, that's a lever. And we could identify 4 levers pretty quickly of what it was that they could be doing that could actually keep cash back in their business to help build up their working capital to smooth through a downturn.
Yeah, it's in this particular economy, it's about preservation of cash and going, how can I keep the cash in my business longer? And that's by either letting it go out slower and making it come in much faster. And we could sit here for hours and talk about all the different strategies.
Yeah, we do love
there
cash.
And I mean, even just talking about how to pay for stock, you can kick the can down the road because there's tools out there about deferring payment for stock. Accounts receivable, we've spoken countless times on how to speed up that cycle with using deposits, use credit card, Stripe, bin that 20th of the month following, invoice, get payment, the accounts payable thing, like what we were just talking about. Asked to pay it off. But I think on the accounts payable thing, as much as you say in your business that you want people to pay you faster, on the other hand, if you've got people that you're doing business with and they're in accounts payable, respect their terms.
Yeah.
And if they want to be paid in 7 days, pay them in 7 days because they want the cash just as much as you do. And we all want the cash to move through the economy at pace so we can all get on with what it is we want to be doing.
Before we go, mate, the thing that we often see that shits us is people spending next year's tax. So they use next year's tax or even the prior year's tax that they've put aside. Oh, don't worry, I'll be paying it in April, but I'm not paying it any faster than I need to. 6 months later, hey, where did that cash go? Oh, things changed. We've had to introduce it to the business. No, you didn't introduce it to the business. You moved it from account B into account A to help you get through. It's still due in April. And so you're using tax money to fund the business's working capital. If you know that you're doing that, you need to reach out to your accountant and say, hey, I think we know we're spending our tax money. Give me a hand. What do I need to do from here?
I think in this, we appreciate that things are tough out there. And if you're in business and you're feeling that things are tough and you're not got a handle on cash, the biggest red flag, I think, for a business owner, if you think, oh, gee, I don't know whether I've got it right or not, is are you paying your PAYE on time and are you paying your GST on time? If it's no to both or one of those, then you have a problem with working capital.
If you need a hand with that, nextadvisory.nz or get in touch with one of us. We don't want people struggling out there when they don't need to be. Otherwise, reach out to your accountant and say that you need a hand with this stuff. It is so important to get on top of it.
Nice one, mate.